Hello, today I'll be talking about quality businesses that the market hates right now. So what exactly is a quality business? So a quality business is normally a tollgate business with incredible pricing power, with secular growth trends pushing the stock ahead, and they often operate in monopolies as well as duopolies. So the first stock that I'll be talking about today is a company called Copart. So Copart year to date is down around 20%. It is currently trading at a 30 times earnings, and it is down around 30% since its all-time highs just 2 months ago. So for Copart, this is their business model. Basically what they do is they will sell all your different salvage cars. So whenever a car gets into an accident or whenever a car is wrecked, the insurer will basically assess whether or not the car is repairable or the actual cost of the repairing is greater than the actual value of the car. So when the cost of repairing is greater than the cost of the car, then what your insurance companies will do is they will get Copart to basically sell the cars for them. And for Copart, what they will do is they will take a percentage of the car sale price. So the higher the prices of the cars, the higher the revenue for Copart. So for Copart, this is their moat as well. Their moat is the land itself. Because in the US, it is difficult for you to get so much land at such a large scale. So for Copart, they currently have around $2 billion of land in their balance sheet, and competitors can't buy land as well. So for their competitor, which is IAA, what they do is they will lease the lands. So when you lease the lands, it will hurt margins over time because you have to pay for the land. Whereas for Copart, what they normally do is they'll pay the land in full cash. So there's no liability, and even if the land is not used, the company won't incur losses. So in the US, there's a trend called not in my backyard. So that is raising the difficulty, and that is raising the barriers to entry for other competitors coming in to buy land and operate a similar business to Copart. So for Copart, it is a tollgate business. So what they do is they are just a platform. They will get the cars from insurers, sell the cars on their platform, and then they'll take a fee off the car sale price. And besides that, they also have membership fees and all your handling fees, which is high margin revenue for the company. And that is why this company is a high quality business. So for the company, the growth trend has always been there. So your automotive total loss frequency has been up and up and up over the past 20 years because number one, your cars are getting more sophisticated. So when your cars become more advanced, what happens is all the parts, they'll be more expensive to repair. And when that happens, all your insurers, they will more likely just basically waive the car off as non-repairable. And with a growing trend of urbanization, what happens is there'll be more cars in your cities. And when there's more cars in your cities, it leads to more accidents as well, which is why this automotive total loss frequency has been going up over the past 20 years. And the management is expecting this to continue doing so over the next few years. And for Copart, the demand for wrecked cars will always be there because you have your resellers coming in from overseas buying the cars. So around 50% of the cars are actually sold internationally because a lot of your car brands are manufactured in the US. So people from overseas, what they tend to do is they tend to buy the US cars and then they try and resell them in their own countries because of the brand name of the cars. And the resellers will also be able to sell by parts at a higher price as compared to what they purchased it for on Copart's platform. So the demand for all these wrecked cars will always be there. So this begs the question, why aren't the insurance companies basically selling all these cars by parts? So number one, they have contractual agreements with Copart, so it's convenient for them to do so and just pass it on to Copart. Number two, they don't have the scale to do so. Copart is the largest car auctioning platform in the entire world. Besides their 40% share in the US, they also have around 50% in other countries, like in the UK for example. And for Copart, because of the scale, there's increasing liquidity for all these different insurers, meaning to say they can sell the car fast and they can sell the car at the highest price possible. And that's why they're not flipping it and selling it by parts, because it may cost a lot more for them to hire the people to do so. So for this company, they have incredible pricing power as well. So they have the membership fee that they'll require all members to sign up for, and that membership fee has basically increased by around 5 to 6% every single year from 2010 all the way until its current date. So besides that, they also have all the cleaning fees, and they take a percentage of the car sale. So when your car prices go up with inflation, Copart will be able to basically increase their earnings in line with inflation as well. So for Copart, this is the valuation for the company. So the company now is trading at around $46 a share. And assuming at 28 times multiple for this company and a 12% EPS growth, I think the 12% EPS should be more or less reasonable. Management is guiding for around double-digit revenue growth and mid-teens EPS growth, so 12% should be achievable here. The company now will give you a CAGR of around 10%. So this means that Copart is currently trading at around fair value. I think so as well. I think this is a quality business that is trading at fair value. I'll be looking into this one and hopefully it drops a bit more so that it looks a lot more interesting than it is today. The next company that I'll be talking about is Fair Isaac, FICO. So FICO year to date is down around 25%. It is currently trading at a 64 times earnings. So for FICO, they have their own FICO score. This company is well known around the US and internationally as well. So they have the FICO score, which is the language in terms of your credit scores, which is why the company has been able to increase prices at such a high rate over the past few years. So for FICO, this is their pricing power. Over the past 7 years or so, they have basically 5x their prices, and they're expected to grow their prices at around 15% CAGR over the next 7 years as well. So when a company is able to increase prices at levels above the rate of inflation, this not only means that the company will be able to beat inflation, it also means that the bottom line will grow a lot faster than the top line, because every dollar increase in the prices is just additional profit for the company. And for this FICO scoring portion, it has incredibly high margins as well, around 88% margin for this segment of the business. And for FICO, I expect them to continue increasing their prices over the next few years. Management has also said that there hasn't been pushback in terms of the pricing, so you can expect them to continue doing so over the next few years. So for FICO, the mortgage market has also been down over the past few years. So in the US, because of the high interest rate, people are not buying houses as often as they used to. So this is currently a headwind for FICO because less houses bought means less FICO score that is being needed. But over the next few years, if the Fed starts to lower rate, this could instantly become a tailwind for a company like FICO. So on top of the 15% pricing growth for this company, if the mortgage market is able to revert to its mean, that will be another 5 to 10% for this company. So you can easily get around a 20% EPS growth for this company over the next few years. That is not accounting for the share buybacks of the company. So this is FICO's valuation. So assuming a 20% EPS growth over the next 5 years and assuming a 40 times earnings, the 40 times earnings is still a bit demanding for this company. At its current price of around $1,500 a share, FICO will give you around a 9% CAGR. So this company is still a bit overvalued at its current price. I think at around $1,400 a share, the company is about fair value. So that'll be when I'll be looking intensively into the stock. The stock now is presenting an opportunity, but it is still pricey at its current price. The next company that I'll be talking about is ADP. So this company is an extremely boring business. It is basically a HCM. In the US, it is the largest HCM there. So the stock is currently trading at 30 times earnings and giving you around a 2% dividend yield. So this is one of the more stable businesses out there. In fact, I think it is an extremely high quality business that Wall Street ignores. So for this company, they have around 50% market share in your HCM space. And for ADP, it is a legacy HCM, so you won't expect them to disappear in the next 10, 20 years. And this company will likely be able to continually compound over the next few years. So for ADP, their metrics are incredible as well. So you have ROIC of 36%, ROC of 50%, and you have EPS growth every single year of around 10 to 15% for this company. So for this company, it is not crazy growth, but it is a stable quality business that will just give you around 10 to 15% returns every single year. So this is my valuation for ADP. So assuming a 28 times multiple for this company, I think this is a quality business. So the 28 times multiple should be more than justifiable. And at its stock price today of $300 a share, the company will give you around a 10% return. So the company is not undervalued by any means. I think if you're able to buy it at around the 25 times earnings or 26 times earnings, this will be a quality add to your portfolio. The company is a highly predictable one, although the growth is not extremely high. You can expect around 15% return from this company if you get it at the right price. The last stock that I'll be talking about is MSCI. This is a company that I own, and I would like to add more to my position in MSCI. So the stock is down around 5% year to date. It is currently trading at a 38 times earnings. So the MSCI thesis is extremely simple. It's just increase in AUM leading to revenue growth of around 12% for this company. So if you are to account for revenue growth of around 12%, accounting the share buybacks for the company, which is around 2% or so, you could easily see around 13 to 14% EPS growth from this company. So this is my valuation for MSCI, assuming a 14% free cash flow per share growth rate, and assuming a 28 times price to free cash flow, which I think is more than reasonable for a quality business like MSCI. At its current price today, you will get around a 12% CAGR. So MSCI is around fair value also as well. Similar to the other companies, it is a high quality business. And for MSCI, I'm looking to increase my position. Hopefully the markets give me a dip soon so that I can add to my MSCI position. Next portion, I'll be talking about some questions left in the comment section. So the first one, it says, can you explain your thoughts on the recent stock price of Singtel? Over the last few years, I would expect telecom to slow down due to competition, but yet Singtel went from $2.40 to $4. Would also appreciate insights on DBS and SIA. So I'm not too sure what Singtel does. It could be something related to the dividends, where they hike their dividends. So I'm not interested in the company because it's a telecom company. It is restricted in Singapore, and you have other telecom companies coming up as well in Singapore. Maybe I can share some of my thoughts. for DBS as well as SIA. So I own SIA. SIA is a decent company, although it's in the airlines industry. For SIA, I think the management are not performing as well as they could, because in the last year, if you were to look into their earnings report, they weren't able to hedge the oil prices, despite the oil prices coming down over the last year. And if you were to compare it to all your different other Southeast Asia airlines, SIA was actually the worst when it comes to hedging for oil prices. And that actually hurt their earnings by quite a fair bit. So for SIA, I think it is a company that is stable. You will get around a 7% returns every single year. I'm not planning to sell my stake. I think the company is around fair value now, and it's a stable business that will just give me dividends every single year in Singapore. As for DBS, it is the highest quality bank in Singapore, but the problem with DBS is simply just the valuation. So it is currently trading at around 1.9 times price to book, which is on par with a lot of your US banks. So although DBS, the ROE is extremely high, it probably commands this price to book valuation. I think over the next few years, if we see interest rates coming down, that's when you see your banks getting hurt and your REITs going up. So for now, I'm staying out of DBS. I've been staying out of this one for quite a while already. I'm waiting for interest rates to normalize so that I can get some of DBS. DBS has outperformed the S&P 500 over the past 10 years. It is likely one of the high quality business in Singapore. So for DBS, I'm waiting for that one. The next question, it says, any thoughts on Lululemon at its current price? So for Lululemon, as well as all your different other clothing, your footwear companies, I think they are low quality businesses because they are all dependent on trends and fads. So for Lululemon, besides the company being sort of like a trend, the company is also going to be heavily impacted by tariffs because they have factories in Sri Lanka, Vietnam, China, and the cost of goods sold for Lululemon will likely increase by around 10 to 15% just based off the tariffs itself. So for Lululemon, I think it is a company that is trading at a decent valuation now. I don't think it is a predictable business that can hold for the next 5-10 years. Maybe for a swing trade, it will work fine because the company is trading at a cheap valuation. But for me, it is an avoid. I'm looking to buy companies that I can hold for the next 5-10 years. So for Lululemon, it is a company that I will not pick. I hope you guys have found this one useful and invest safe.